Good evening, all. We extend our sincere gratitude to each one of you for taking the time to join us on this busy Monday evening. Today, we will provide a brief overview of the market outlook and update on our portfolios. So, we are pleased to have Mr. Hitesh Arora. He's one of the fund managers with us. Mr. Hitesh is a fund manager at Abacus. He brings with us, he brings with himself a strong domestic and global market outlook experience after having worked with institutions such as Unify Capital, Deutsche Bank, and JP Morgan for about 2 decades. He has worked with across multiple roles in capital markets, including equity, research, fund management, structuring, and risk management in India and abroad. He is an MBA from IIM Bangalore, MS from Columbia University, New York, has done his BTech honors from IIT Kharagpur, and is also a CFA charter holder. So over to you, Hitesh sir.
Thanks, Ashwara. Thank you. Good evening, everybody. We'll just start the discussion now. We'll start with the market outlook. What is happening in domestically? What is happening across the globe? And there's a lot of action over there. And then finally, we'll discuss on the what's happening on the portfolio side. So this is just a quick snapshot of how the global and the regional indices are behaving, including India, of course. And how does the 1 month, 3 month, 6 months, 1 year, 2 year, 3 year, and 5 year returns stack up for the indices and for both the Indian indices as well as the global indices. So just as a quick if you look, over a 5 year term, if you in the on the right hand column we have the ranking. So you'll see that the Indian indices, essentially the mid cap and the small cap, they've done extremely well. They rank first and second. The small cap ranks the highest, followed by the mid cap across all major indices across the globe on a 5 year basis. And again, similarly on a 3 year basis, the mid is the best performing index, followed by the small cap indices, small cap index. So over a 3 and a 5 year horizon, the Indian mid and the Nifty mid cap and the small cap indices have done exceedingly well. But what has happened is over the last year, so if you look at the 1 year column, the returns have been -1 to -8 for these indices. And then if you just move back one column on the left, if you look at 6 months returns, 6 months returns have been -19 and -24%. So essentially, if I can say that over a 1 year, we've been safe, we've been flat, give or take, but a lot of the return have been taken off, have been erased over the 6 month period for the Indian indices. While some of the other ones have done well, but at least on the Indian side, the 6 month returns have shaven off some of the gains that would have made in the prior 6 months, prior 6 month period. So that's the sort of the backdrop we are in. Last 6 months have been extremely volatile. Feb has been extremely volatile. Since September, things have been a little on the downside post, but we need to keep in mind a strong 5 year run, a strong 3 year run, where indices have, on a cumulative basis have doubled. So this is the sort of the backdrop we are in. Or yeah. So I think this is something very, this slide is something very topical. There's been a lot of talk about FII selling in the market, so we thought it would be good to delve into what the numbers look like for the FIIs selling, how much they've sold, what has been traditionally, what has been the quantum of selling by the foreign institutional investors, and also how it stacks up vis-a-vis other emerging market economies such as Brazil, Indonesia, Malaysia, Philippines. So just if I can just draw your attention over the last 2 months, so calendar year 25, Jan and Feb. In the secondary market, you've looked at around 13 billion of selling, while the IPO market has, sort of almost shut for the last 2 months. But these numbers are, if you compare, if you just take one step back, you look at CY24, they've been, albeit over the full year, but not just over these 2 months, the quantum has been relatively same. But what has changed is they've sold it in the secondary market, but they've bought it in the primary market as well. So they've almost net balanced out. But here, while they've sold it in the secondary market, there's no action in the primary market, and hence it looks difficult. But again, if I just go back to say 23, again, a lot of buying in the primary and the secondary market. Go back 1 year back, CY22, significant selling again in the secondary market, but relatively smaller amount of buying in the primary. Was again significant net selling in the secondary market. So while there's been a lot of noise around the primary market, but you just need to keep in mind, this FII selling just accounts for less than 3% of their overall holding. So it's more of the sentiment that counts, but the absolute amounts are not significant. So these are not the driver of the market falling. So it's a lot more noise around here than the actual amount of selling. So it's more the sentiment, and in the next few slides we'll just delve into the sentiment aspect of it, and why the sentiment has suddenly changed to a little more bearish than what we were, say, 6 months back. We'll just delve with the numbers there. So I think, a lot of the growth in the earnings is a function of, how do we sort of define growth? How do we, in a sort of a simple substance, is a function of the growth reflects the GDP, if I may say. So, stronger GDP growth will be reflected in the earnings of the companies. So post COVID, we've had initially low base advantage. We've had a good run. We've had GDPs, in 2020, 23, 24, and early on as well in the F25, we've had GDP momentum strong at around growth rates around 8.1, 8.6, 7.8%. But over the last, say, this year, we've been sort of faltering in terms of growth. GDP rates in Q2 FY25 came as low as 5.4. So it was a function of a lot of factors, including sort of the high base effect of the last few years. So, you had the COVID fall, and the next 2 years were good because you had a lot of spending by the government. You had a lot of a low base advantage, if I may say. So you had a lot of things working in our favor, and suddenly you were fighting against a high base. You had the election season where a lot of things stopped. You had some weather-linked seasonality as well. So we were fighting again, so the multiple negative factors here. But I think what is, so this is one bit of it. So we have a short-term cyclical slowdown, and nothing denying the fact here. But the chart below compares the GDP growth rate, the numbers in orange, versus the GDP growth rates for the advanced economies. So if you look at it, India over a longer period of time has been on an uptrend, while the advanced economies have been on a decline. So there's a blue line that goes downward, and there's an orange line that goes upwards. So over a longer period of time, but for this short-term cyclical slowdown, we are on an uptrend, and the developed world is on a downtrend. So that framework broadly helps us. We are on a long-term growth trajectory. So this is one. What helps us is our current account deficit is low. We've got lower public debt. We've got significant foreign reserves. We are very conservative in the way we spend. So our, deficit as a percentage of GDP is around is sub 5%, and the glide path is there. It's certain, and the government is very cognizant of the fact that we need to bring down our fiscal deficit there, which broadly increases investor confidence, and hence inflows into the economy. So this is one. The other, so this is on the domestic side. So we've had a slower GDP growth, but from our domestic defenses point of view, I think we are broadly good from a macro, and a micro policy standpoint. We are good, but what the world has seen is a lot of volatility in terms of initially it was the Russia-Ukraine war. And then there's war in the other two continents as well, but that's sort of seen by the other two continents, I mean China, Taiwan, and the conflict in the Middle East. So these two have sort of slowed down, but there's a lot of noise around the Russia-Ukraine war, especially recently, that you would have seen. There's a lot of talk around tariffs by the Trump administration in the US. There's a lot of noise around there, increasing tariffs, putting tariffs, keeping tariffs on, increasing tariffs, and then keeping them on hold for a month or so, things like that. So there's a lot of noise around there, which increases the uncertainty in the world, which reduces investor confidence. So some of these things are at play, which also impact the flows in the market, and also which leads to some sort of a correction in the market. So these are some of the two things. So uncertainty and our slower GDP growth rate. So I'll just delve in the slide on what we discussed in the previous slide a little bit more deeper. So post COVID, there's been a lot of spending by the government. As you can see, our fiscal deficit post in the and also which was a function of the lower GDP as well. So the fiscal deficit as a percent of the GDP during the COVID times moved up to as high as 9%. But the government has been and that's also a function of the continuity in terms of the government regime. It's the same NDA government being in power again. So they've been very cognizant of bringing this deficit back to the 4.5% or thereabouts by FY26, and that's been reiterated time and again by the government in its both in the budgeted estimates as well as in the revised estimates. So there's a lot of confidence there, which also keeps the currency in control, and also prevents sudden outflows in the market. The other thing I just wanted to highlight, one was the chart on the right, which talks about the central government capex on a YoY basis. So if you look at it, the government spending on the capex has significantly gone up post COVID, and it's been on an uptrend, if I may say, or up, and I think it's sort of reached a peak as where they want to be thereabouts. So between in the pre-COVID years, we were capex as a percentage of GDP was around 1.7%, which has steadily increased and peaked to about 3.2%. And over the next 2-3 years, we are looking at a number of 3.1. So on a relative basis, from 1.7% of GDP, it's gone up to 3.1% of the GDP. So it's a function of both. The GDP itself increasing over a period of these 6-7 years, as well as the proportionate allocation that has to the GDP is also increased. So this is one bit. So overall spending on the government spending on capital expenditure is increasing, and that's good. But what's happened over the last year, then that's referring to the chart in the middle. The central government over the last 1 year, which has been the election year, the spending has come off quite sharply over the period from May to November, if I may say. Spending has come off quite sharply, and that's a function of a lot of things. It's been elections, so policy decisions take a standstill, and then the new government coming in, the cabinet being formed, state elections, for example, in Maharashtra, extended monsoon. So some of these things, and that's the seasonality bit of it. So some of these things have led to a slowdown in the government spending, which also reflects in the slower GDP growth. But based on the revised estimates that the government came out with, significant spending capital expenditure spending is happening in the months going ahead. So in the months of January, February, Feb, and March especially, you should see significant amount of spending, which should aid GDP growth. So that's that's one positive. The other positive is from the budget is giving more money in the hands of consumers, which should again aid GDP growth. So I'm just talking here about the the cut in the income tax rates and the modifications thereof, which the market projects to around 1 trillion, so 1 lakh crores in tax savings, which should aid significant spending. So these got a flywheel effect in the economy. So people spend money, which creates jobs, and that creates a and which creates jobs, which creates more money in the economy, in the hands of gives more money to the hands of the people, which again spend more. So that's a flywheel effect in the economy that leads to a significant should lead to significant GDP growth. So these are at least some of the measures that we have. We also have measures uh, such as other in terms of higher rural and agriculture spending by the government, which again should provide higher credit limits to the farmers. So both on the farm side, both on the on the personal consumption side, we've got significant spending. And this is just one bit of the measures. We also have measures from the RBI, etc., which have lowered the risk weights on lending to the micro to the banks, to the NBFCs. So a lot of measures being taken by the government in terms of aiding growth, via whether it's via credit growth, whether it's via personal consumption spending, whether it's in the agricultural sector. A lot of measures are being taken by the government to increase spending, increase growth in the domestic economy. So from a domestic stand, and while still being in the keeping our deficit in check. So we are spending, but we are keeping, we'll only spend as much as we are sort of prudently that we can spend. But we just do it more optimally. We do the spending more in a more optimal fashion that should lead to better GDP growth. So that's the ultimate idea here. So one of the things that we've been constantly talking about inflation and keeping things in fiscal deficit, etc., in check. Excuse me. So one of the things, what we've seen is we have given our control on the fiscal deficit, but for some short-term spike, thanks to some, food inflation, etc., an inflation level is under control. So it's slightly above RBI's, comfort level of 4%. But this year, given a lower food inflation, we should see the inflation numbers coming, the CPI inflation numbers coming to 4%. If I look at the chart on the right, which is the India 10-year bond yields, again, bond yields have been stable, which again reflects the level of inflation in the market. So bond yields have actually come up. What has been very, India in that sense, been very good for us is the crude prices that have come up quite sharply. So these higher crude prices feed into the economy to lead to higher inflation, higher transport costs, etc., which would lead to higher, fruits and vegetables cost, higher raw material cost overall. These would then feed into in terms of higher inflationary. So lower crude prices is very good for the economy in terms of controlling the inflation and etc. So this is one good thing we're looking at. We're looking at 10-year bond yields in the US and in the Western world overall. You would have seen the inflation numbers after a long period of lower inflation since the global financial crisis that was back in 2008. US inflation had a shot up. Post the Russia-Ukraine war, inflation in the Western world shot up. But thankfully here again things are back in control. But for this whole tariff talk, which the backdrop, which is yet to be seen. things, inflation as far as things stand as of today, the inflation number is in control. Uh, what is I think what would again is interesting is the what we've put here is set also is the German 10-year bond yield. So this is something that's very interesting. Bond yields, which again reflect a real inflation and the reflection of the inflation, the growth rates or inflation in the economy. The bond yields have shot up dramatically in Europe. So we've just taken Germany as an example, and that's a result of this whole Russia-Ukraine war. How much is they are going to spend? Do they care about the fiscal deficit or whatever the goals that they had in mind? They are breaching that. As a result of that, the German 10-year bond yields have shot up quite drastically, and they've been since if I go back as 2008, they've been highest since then. So that's I think that shows the dichotomy in the world. While India bond yields kind to be very stable, US bond yields have stabilized at a higher rate, at around 4% or thereabouts, but still stable. But it's the in Europe, something else, something very different is happening. This shows the sort of the uncertainty or the volatility in the world and how different regions in the world are reacting to sort of the global news flow, to the global dynamics, and how that affects each country or continent. So this is something. So I think this is something very interesting. So this is just on the in the currency bit. So over, uh, let me just go to the table on the left bottom side. Uh, the This is how the major EM currencies have performed against the US dollar over the last 1 year. So these are returns over the last 1 year. The Indian rupee is fallen about 5% or thereabouts over the depreciated against the dollar by about 5% or thereabouts. Uh, but while on an absolute basis it may seem significant, but we have to keep in mind two things. Rupee or emerging market currencies itself will depreciate against dollars given the high interest rate differential. So there's that parity rule that applies. So EM currencies will depreciate over a longer period of time. In the shorter term, they are driven by flows. Outflows will increase demand for dollars, and hence the EM currencies will fall. But what is I think significant is from a policy stability standpoint, I think we've done really well. We've done exceedingly well, and you've seen some of the Brazilian, Mexico, Russian currency, or the Turkish currency, or the South Korean won. We've done significantly well. A large part of this, if I go to the chart on the top, is driven by how the dollar index has performed. So the dollar index actually post Trump coming in performed, make America great again and all these things. So the dollar significantly appreciated against the basket of currency that it weighs in, and that's the likes of the euro, pound, yen, etc. So the dollar index moved sharply. It's only in the last, so it moved to around the levels of around 108 or so until the last month. It's only in the last 1 month or so when the sort of the euro appreciated, has the sort of index given up its gains. But having said that, compared to the other how the other DM currencies has actually performed, the rupee on an absolute basis has actually performed quite has has held up strong, if I may use the word. So this is more of the what we can say is more of the appreciation of the US dollar as against the depreciation of the rupee. So the rupee is actually on an absolute basis. I think the government's done a really good job. The rupee's done phenomenally well, if I may say. And also, this is also a function of the FX reserves that the Reserve Bank of India holds. That's significantly higher levels, and they've been continuously going up. So, any external shocks, we've got enough reserves to manage any external shocks. So this is something I think this is quite significant in terms of the global flows, and especially in context of the volatility that we've seen and which we may continue to see over the at least for the next 6 months or so, until all this sort of noise cools off. This is one. So specifically on India, uh, as we said, and we've discussed it multiple times, markets have been volatility. Two factors: near-term earnings slowdown and this whole tariff noise. Uh, FI GDP corporate growth, we said, is going to be muted. We've seen it in the first, 9 months, but I think things should pick up in FY26. Relatively quite confident there. Uh, Again, inflation, I said, is around the 5% range, but I think this should come to as the food inflations come off. This should also come off. Domestic liquidity, via SIP flows, etc., and RBI taking, position in open market operations. So a lot of support there in terms of domestic liquidity is both on the institutional side is as well as on the equity market side. Domestic liquidity is quite strong. Okay, so it's more of a function of earnings coming back, which we expect in FY26 to come back. It's again a function of this whole, the noise, the uncertainty, the noise around war, a lot of tariff noise. So all these things, if they die down, I think again we should be in good stead over here. So these are some of the things that we need to keep in mind. So this is just, this is what are the actions we just want to take. This is again, from the bigger point here is from a policy standpoint. I think we've been very accommodative. Whether it's the central government or whether it's the RBI. If everybody's trying to aid growth, whether these are the OM operations, the buy sell swaps, whether it is reducing risk weights for by on lending by banks to NBFCs to aid growth. Some of these measures are very, very pro growth. So just from a policy standpoint, rate cutting from a rate cutting practice, or from a liquidity infusion in the market, as I said, from dollar INR swaps, CRR rate cut, or just as I said, reducing risk weightage. So all these steps are very, very pro growth by the Reserve Bank of India. So as a similar, again, it goes back in the in a very similar thought process. The government, via the various tools that it has, is very, very is looking to aid growth. It's very pro growth, and so is the institutions such as the RBI. Just on the valuations bit, and I think that's something that everybody would be interested in. Valuations had run up. We know over the last 5 years, markets have significantly run up ahead of the earnings. Multiples have re-rated. Some of this had to correct. So there were various. Growth was slowing down, we knew, and then this whole Trump thing came, and then sort of markets gave in, if I may say. So since the last 6 months, we've seen significant correction and very sharp correction in the month of February. So now the markets are trading closer to their historical mean levels for the Nifty, for example, on a P basis, even on a Nifty PB basis. So markets are closer to their fair value. But I think something very important to remember is markets never trade at the fair value. They either undershoot or they overshoot. So they could remain here, but they could also fall from here a little more. We don't know, given the uncertainty in the market. But markets rarely trade at their fair valuations. And this is just specifically on the sector valuation. So if we look at the multiples for different sectors 1 year forward, how things look like. So capital goods was a sector that had significantly run off. Things were trading at 45 p is the index average. Some of the names were trading at 70, 80 p, or maybe close to 100 p on a 1 year forward basis. So some of the names in the sector have come off. Autos were never that hot. Banks have significantly corrected. Uh, PSU banks last year had significantly run off, and they have given off their gains as some of the earnings drivers sort of slow down, including credit growth, margins shrinking, things like that, and credit costs were negative in the last 1 or 2 years. So we'll see that normalization of credit cost happening. A lot of benefit to pharma companies from China plus one strategy. So there was a lot of noise around there. This whole CDMO thing there. So pharma companies were quite hot until last year, and they've given up some of the gains. Similarly, post COVID, IT companies had been trading at expensive levels, so some of the gains there, but still continue to trade expensive compared to what levels they were pre-COVID. So this just gives a sort of a top-down view of how expensive or cheap things were on a relative basis compared to a few years back. Similarly, on consumers, as things have normalized. So this is just the other one is this table just gives a summary of how the different indices have performed on a CAGR basis over last few years. So this and where we've taken a big knock. That's something. So Nifty, if I just do a quick one, so Nifty PSU Bank Index has significantly fallen off for the last 1 year. Nifty IT, Nifty Reality, some of these indices have taken a sharp knock over the last 3 months. Similarly, with Nifty Media Reality, some of these things have come off quite sharply. Actually, if I look at it, it's pretty much last 3 months things have come off quite sharply. It's just in the financial services name. If financial services, by financial services, largely the private banks. I think the private banks have done a relatively decent job over the last, say, on a relative basis over the last 1 year. Otherwise, yeah, things don't haven't been that green over the last 1 year. But just on this, harping a bit on the same point again, on a domestic standpoint, we look good. All the different parameters that we look at, whether it's UPI, whether it's GST collection, whether it's the capex spending on the national highways, which drastically increases efficiency in the domestic economy, or our general energy consumption. All these parameters, I think we're doing a very good job. But for this cyclical slowdown, I think India as a economy is doing on these parameters is doing a good job. This is the other one I just wanted to highlight is the center. This is how much we've been spending, and this was something that we discussed in the past. Capex as a percentage of the GDP is we spending around post COVID years, we were spending significantly higher. This has come off, but this should be as a percentage. I'm sorry, this should be as a percentage of the overall budget. How much are we spending? We're spending around 10% of the budget on capex. This is not a percent of the GDP. I'm sorry, but the numbers are significantly higher that we continue to spend. And while in the post-COVID years, we've spent higher amounts. Just to drive the economy back from the lower levels, but these numbers still remain significantly higher at around FY26 budgeted estimate is around 10% of the of our GDP. So numbers are significantly higher. Industrial growth remains high, whether it's the PMI, all the manufacturing index or the industrial production index, industrial credit growth, things look good. And it's not and also the government is also very cautious in terms of things don't go into a bubble phase. The moment things go into bubble territory, we've always seen whether it's the RBI or the government taking actions to rein in the economy. So we've always, we've never gone into, even when the market went to a bull run, we were never into a bubble phase. So the in that sense, the correction will always be, is more palatable because things haven't gone that far in the bubble territory. Whether it's credit growth, whether it's spending, by the government, capex by the government, so things like that. We've been very cautious around spending those numbers. So this I'll just skip this side, but I just wanted to draw your attention on a lot of risks around the economy. While domestically, as we said and we've discussed enough, we doing well, but it's remember that this slowdown has the outflows or the correction in the market. It's more India specific than the other DM specifics. The DM markets were still doing okay in the months of Feb when the India market came off. So it wasn't a global sell off. It was a very India specific sell off. Though the factors were obviously a lot to do both domestic as well as international. So some of the things that we need to be cognizant of is this whole tariff wars. What happens to the global economy under this whole uh, tariff regime. So, whether China dumps, if there are tariffs on China, what does it do with its excess capacity? Does it dump it in India or elsewhere? So some of these things, there's a lot of uncertainty around there, which also takes off the confidence of the, Indian corporates. So whether they will then invest in capex, because then they are also not certain if I should be investing in my own capex or whether things will be dumped in the market from China. So a lot of uncertainty there. So these are some things we need to be cognizant of, and we are as we evaluate our investment decisions. That's something that this whole tariff angle always comes to our mind. So that's always the mind. Uh, the final comments, yes. So just bit of a recap here. There's been a short-term cyclical slowdown, but just in terms of otherwise the health of the economy, the policy framework that the central government has laid, or the action that the RBI has taken, or in the general, the what are the actions in the budget that have been taken that show the intent of the government as well. I think we are in a very good stead. From a medium term perspective, we are in a very good stead. Post sort of a post COVID, there was a high base that built up. So some of that correction has happened, and then there was some sort of a seasonality, and then this election related slowdown that has happened. But from a medium term perspective, I think we are better placed. There are uncertainties in the international market. Unfortunately, there's little that we can't control those. I mean, to be honest, we can't control those, but we can position our portfolios in a sort of a more smarter fashion. That's something we can try and do, or we can be a little more. As I said, we don't do any knee-jerk reactions right now, so we're being a little cautious. So that's the sort of the attempt from our side to tide off this period of volatility. But from a sort of a medium-term perspective, we are in good stead, and we are taking active decisions. We are considering active decisions, which we should show up in action over the next few months as well.
So, thank you, Vijay sir. Thank you everyone for joining the call.
Thank you.
Thank you.